Just thank you. Thanks very much for the warm welcome. I don't know if we should wait a little bit longer just to let a few more people join. But it's really great to have a platform like this just to bring the news of trade credit insurance to the broker market. Trade credit insurance is one of those funny products that seems to be the best kept secret. And certainly, as you pointed out, in this economic environment that we've been experiencing for the last, should we say, 15 years, since 2008, it's certainly topical and quite relevant, and certainly a product that we are busy rolling out to brokers across the country, as opposed to keeping it this specialist best kept secret. It's about enabling our brokers and brokers that really love the iTOO and the Hollard brand to enable them to be able to advise their clients appropriately to take out trade credit and to protect their businesses. So we're quite excited. I see the numbers are starting to stack up. So Caesar, will you let me know when we're ready to rock and roll? And we can get cracking from there.
Yes, you can proceed. Yeah.
Should we start?
Yeah, let's get started.
Okay, fantastic. That was close. Almost exited the meeting. Okay, so I think let's just to start off, there have been quite a few changes in the trade credit space at the moment. The product is growing, the business is growing, and I just wanted to give a quick refresh on who the team is, and just let you know who you can chat to. We always find that it's really important for us as a product provider that our brokers know who they can phone when they need help, when they need assistance, or when they need a favor. So if we can kick on to the next one, I think what's important there, as Justin mentioned, so Helene recently joined us at the beginning of August. Helene comes with a long set of credentials. Most notably for us is Helene managed our treaty renewal as a reinsurance broker for 2 years through COVID, which was really useful. And Helene gained a great insight into our business and the way we manage our business, especially in times of turmoil like COVID, the riots, the floods, the Russian war. And I'm not going to go much into that. But before reinsurance broking, Helene was actually the CFO for Credit Guarantee. So they're the largest player in the trade credit space. And Helene's joined us, which is really exciting that Helene will be joining us as the Chief Operating Officer, and she'll be managing the business so that I can be in front of you guys and I can join you and your clients at meetings and assist you in rolling out this product to your clients who sorely need a product like this, as I said, in an economy that we're in. So Gita handles our claims at this stage. So if you've obviously got any claims, you can send them straight to Sarge. If you need a favor, if you need assistance in how to manage the claims, Sarge is your lady. And we really are also looking for more claims people. I think that's kind of the knock-on effect of the economy that we're in, is that there are claims. And that's both a blessing and a curse. It's a curse because nobody likes the loss ratio, but it's a blessing because it just proves, I suppose, that the product is well needed in this environment. From an operational perspective, Rose handles all of our systems training, invoicing, legal and compliance. So if you're a new broker that's looking at joining our panel, Rose is your girl. And if you're looking at trying to find out where your commissions are or what your policyholders owe, again, Rose is your point of contact. From a risk perspective, Shanice handles that area. Risk is really where kind of the rubber hits the road and where we manage all of our exposures that we're on book for. We make sure that we're not unexpectedly exposed to risks that we shouldn't be exposed to. From a sales side, I'll obviously continue managing the sales and the distribution side of the business, and I'll be assisted by Gillian, who's moved over from our underwriting department. And Jules will be assisting me in making sure that all of your questions and your queries are answered, and that you know exactly what to do and how to advise your clients. So at any stage, you get in touch with myself or Gillian, and we'll be able to point you in the right direction. From an underwriting perspective, as you can see, that's our largest team in the business, and that's because underwriting is really the tricky part of our business. Trying to assess a risk at this stage in this economy is no small feat. It's never been easier to sell a trade credit insurance policy because everybody's worried about default. But in reality, to pick a risk and to really advise our clients on how to trade safely We've got Nikki Stoltz, who heads up our team, followed by Karabo, Lilani, Rulof, and Vusi. Karabo and Vusi recently joined us in July from other trade credit insurance companies. So we've got quite a nice span and quite a breadth of industry knowledge. And certainly the underwriters come with many, many years, most of them more than 15 years of trade credit underwriting experience. So we really have a strong team of underwriting risks. But most importantly as well, if you look at that, trade credits at hollard.co.za, send us a mail, get in touch with us on that basis. Everyone in the team has got access to that email address. So if at any stage you feel that you're not too sure where to go or who to ask, trade credit at hollard.co.za is your point of call, and the team will then distribute it to whoever needs to action your request. So one quick update again. I mean, I'm not going to go into trade credit insurance 101 like I have done in previous iTOOsdays, but one really important enhancement that we've made in our trade credit policy is that we've included a loss trigger or a default event called protracted default. And the reason why it's quite a significant increase or improvement in the product is it was a loss event that the rest of the insurers had in their policy, and we chose not to put it in the beginning. Funnily enough, the reason that we chose not to put it in was actually because our current loss events pay out sooner than a protracted default. So we found out that it was a bit redundant adding in a loss event that would pay out later than your normal loss events. But we did find that being, call it the new kids on the block, even though we've been doing it for 7 years now, is that policyholders who were looking to move from another insurance company to us really wanted to include protracted default. So we've got 5 loss events in our policy. We've got the acknowledgement of debt, which is the one that pays at 60 days past due date. So that's the one that pays sooner than the rest of the market. We've included protracted default that pays 180 days later. We pay out on a court judgment. We pay out on business rescue. We pay out on liquidation. Okay, so those are the events that we would pay out on. All of them are about an undisputed indebtedness, except for protracted default, which just says that as long as the guy hasn't paid and there isn't a dispute, we don't need to confirm the debt, then you'll be paid anyway. So those are the 5 triggers that exist under our domestic policy. I'm not going to go into too much on the export side for now, but certainly if you are looking for cover where your client is trading with countries outside of South Africa, get in touch with us and we can certainly assist you from an export perspective. So just one quick little update on trade credit insurance. I think what's really important for the brokers to understand is that a standard insurance policy is one where the policyholder is the risk. So the policyholder is the risk. You as the broker bring the client to the insurance company and we come up with a solution for your client. Trade credit insurance is a little bit different, and there's a nuance there where the policyholder is not the risk. So we're not, and it hurts me to say this a bit, but we're not particularly interested in the policyholder because the risk are the clients that your policyholder is selling to. That's where the rubber hits the road, and it does come with a few complexities. So this triangle is really just a relationship to explain how it fits together. And at the heart of this engagement is, funny enough, the broker. Right? So the policyholder is the one that wants the cover, but the debtors or the clients that your policyholder sells to are the ones that we need to assess. So that's where the conversation comes in, where we need to go to a third party. We need to assess those risks in order to evaluate them and make sure that your clients are trading safely. Last point from me here is our key differentiators. I just find that it's important for me to rehash these. I know it's not much of a sales presentation, but I'll take any opportunity to tell you about trade credit insurance. And really what's important is that we pay sooner than the rest of the market, and we've got more loss events than the rest of the market. So our policy is designed to respond. It's designed to enable the cash flow of your clients' businesses. And I say that if you kind of look at where the history of trade credit insurance comes from, it's a European-based product, and it's based on an economy that doesn't really have an interest rate, right? So the European interest rates are at 1-2%, typically on the prime lending rate side. And if you're looking at a product, like I said, protracted default, that pays 180 days past due date, or 6 months later, right after you've done the delivery, the cost of credit over 6 months is not too much. Whereas in South Africa, we find that the cost of credit, if your client is having to fund that default, right? So imagine your client has bought goods that they've sold on to their client, and their client hasn't paid them, right? Now they're carrying the risk because they've had to pay for the goods and they haven't been paid yet. And then they have to wait another 180 days before they get paid. That's 6 months later. We calculate the cost of interest in South Africa, or the cost of credit, at about 2% a month. So if your client is waiting 6 months before they get paid, that's 12% off their bottom line. Now you take 12% of your numbers, and I think you'll quite quickly see that all of a sudden it's a really difficult space to play in. So we changed our loss events to pay as quickly as possible, because you find that it's more important for the insurance company to carry the cash flow risk than it is for our clients to carry it. So that's a really crucial component for our business. Our next biggest differentiator is that our clients choose who they want cover on. You don't have to insure your entire debtors book. You can choose which clients you want to insure, from one transaction, so one shipment, one recurring buyer, all the way through to the whole book. We can handle all of it. And our system went live. I think the last time I spoke to you, our Tanubu system had recently gone live. So we've got an online portal that allows our clients and our brokers to interact with us through the portal. So requesting cover, withdrawing cover, amending cover, noting claims, notifiable events, premium declarations, all of the policyholder requirements are actually handled through a system that you and your clients would have access to. And certainly when a policy is incepted with us, we conduct quite an intense or an in-depth training on the system, and that allows the clients the peace of mind to interact with us. It's not a difficult system, so don't panic. It's quite simple, quite intuitive, and you'll see that it takes you about 5 minutes to get used to the system. The next really important part of our business is that we only charge premium. We don't charge fees or any kind of other cost burden on the client. It's purely about premium for us. And that's for two reasons. One, we want our clients to know that we're incentivized to going on risk, right? With the difficult environment that we're in, it's quite easy to decline a risk, to avoid a claim. But in reality, then we've just spent money on underwriting risks, and we don't really have any avenue to recover those costs. So we only charge our premiums so that they know. So we only charge them premiums so that they know that we're incentivized to go on risk. And the other reason why is because brokers earn commission on premium, where you don't necessarily earn commission on fees. So at least the broker is getting as much bang for their buck out of the policy that we put in place. The fourth kind of really important differentiator for me is that we join our clients in the journey of what a claim looks like, right? So we pick up all the pre-legal costs in proving the claim, letters of demand, acknowledgement of debts, all of those legal processes. We pick up all of those costs in proving a claim, and we even pick up legal fees right up to the point where the matter is disputed. And the reason why we stop picking up the legal fees when a matter is disputed is because this is a credit policy. It's not a performance policy, right? So the policy is designed to pay out in the event that the client has failed to pay when they should have paid. If a policyholder has delivered substandard product or a substandard service, then in reality that debt shouldn't be due, and actually they shouldn't get paid for not doing a really good job. And our policy operates on the same basis. So we will continue picking up that legal fees right up to a point where the insured debtor or the defaulting party has said, well, actually, you've delivered the wrong thickness of steel, the wrong quality of cement, the wrong quality of service. You didn't build the house. I mean, there's many reasons that somebody could dispute. But what's important is because we pick up those legal fees right up to that point, we remove any doubt on frivolous disputes. So frivolous disputes are things like, oh, we didn't pay you because the internet was down, or we didn't pay you because we didn't get a statement, or our credit controller was on leave, or those silly reasons to not pay. Because we're able to carry the financial implication of that process, we sift out quite a lot of those call it erroneous disputes quite quickly. And then once we've paid a claim, we pick up all of those costs in recovering the debt. So every time we handle the file right up until it's finished. And that's a really important process for us, that we carry that can so the client knows again that we're in line with their requirements. right? There's no surprises, like I said, on the invoice where you get premium and then there's fees, and all of a sudden your cost to your company or your client's company is more expensive. Similarly, you also don't want to be in a space where your client puts in a claim and all of a sudden there's a claim. Obviously, there's an excess like all insurance policies have. And then there's another line item saying legal fees that have been reduced. And all of a sudden, the client's indemnification is not as high as they expected it to be. That's just something that shouldn't exist. And the client should always know what they're going to be indemnified for. And by us picking up all those costs, obviously the client isn't surprised. The final component that makes us really different is our holistic credit management. And what that really is we look at the end-to-end component of credit management, right? We look at what we call, and if you've heard this before, I apologize, but it really is the nuts and bolts of our business. We pick up the how. So how does your client interact, right? We get the credit agreement from the client. That credit agreement is the binding document between the policyholder and the insured debtor. That document tells you how you're going to deliver, how you're going to get paid, how you're going to arbitrate, can you charge interest? Most importantly for us is that it tells us whether we've got consent to underwrite the debtor or not, and if we can share that information with the policyholder. Right? Trade credit insurance was invented long before puppy, but certainly since puppy came into play a few Julys ago, we've really hit quite hard on that agreement and needing that agreement in place. So we make sure that we've got consent to underwrite. We do a fraud verification component of that business to make sure that your client is trading safely, right? Because at the end of the day, even though a client could be delivering cell phones, pens, concrete, as I mentioned, in reality, the insurance contract is the insurance of that credit agreement. That's actually the transaction that we're insuring. And the tonnage of cement is just the quantum of the claim. So we need to know what that agreement is, because that's going to determine how we respond. We then also kind of leads into what we call the who's. So who exactly is your client dealing with? We do an in-depth underwrite on every single one of the risks that come onto our books, and we share that information with the client. We can do that because we've got consent through the credit agreement. And that component is really important because in an environment like this, where sometimes we do decline risks, right? And we say, guys, that's just not a good risk. It's not something that we're comfortable with. We can tell the client why we're not comfortable so that your client is in a space to make the right decision for their business, right? If they've got other information that they can give us that can convince us to go on risk, we're all ears, right? We don't sit in our ivory tower here in Parktown and dictate this is how business operates anywhere in South Africa. We like listening to our clients, and we like getting context from our clients, and we like backing our clients to enable trade. Because if we're not enabling trade, the economy is going to continue in a really tough space that it's in. But I'll leave that to Helene in a little bit. And then the final component there, which is not necessarily a differentiator, but something quite important, is that we're going to be scheduling broker training every second Thursday of the month. So every second Thursday, we'll be sending out and we'll be blocking out call it a 90-minute session. It'll be scheduled for trade credit training, and that'll happen every second Thursday, every month. So if you want trade credit training, jump on. It is CPD approved. I don't know if you can get CPD points for the same presentation, so I don't know if that's going to benefit. But certainly the point of the game is that we want all of our brokers to be comfortable enough to mention trade credit insurance to their clients and allow that interaction so that we can actually protect their businesses and make sure that they can survive the tumultuous economy that we're experiencing at this stage.
Right, thanks, Gareth. So I think from my side, I'm very pleased to have joined the Hollard Trade Credit team and the iTOO team as a whole. Maybe as a precursor, I'm not an economist, but my nerdy side does come out. So I do spend a lot of time going through some of the economic numbers. And I think the intention is not to see it as a doom and gloom session. And it really is an interpretation of what the numbers are saying to us. And again, overlaying that story onto the balance sheets and the information of these buyers that we get. Because every company is different and every company operates differently. But we all get hit by the same thing. And it's just how well can we run through it, and how strong is that balance sheet to sort of continue weathering the storms that have been hitting us. So starting off with the doom and gloom, because it's always important to get the worst over us and behind us as quickly as we can. We all know the South African GDP outlook and GDP growth is really not positive.
I guess can't you?
Okay.
Will you unmute yours?
Yeah. Right, you should see the screen again. Perfect. Okay, so I hope everyone can hear me now. But really, the South African GDP is a sad story. Where we currently sit is our GDP is sitting at 0.2% in the 2023 forecast. The IMF is putting it at 0.3%. We are the worst performing country in the Southern Hemisphere or the Southern African region. But to put it in context, Southern Africa is also only trading at a GDP of 1.5 to 1.7%, depending on who you're talking to. Now, when you start going into sort of the different views, for our South African economy to truly grow, to truly start offsetting the joblessness and start getting some momentum in terms of a positive outlook, we probably need to be in the range of 3 to 5%. So there's still quite a lot to do, but the positive is that our GDP is above 0%. Companies continue to trade, and I think the African resilience is showing. And if you look at the graph, we've recovered quite well through COVID into 2021, and we're pretty much back to our 2018 numbers. So it's just to grow from that point onwards. Again, what impacts a lot of our companies and a lot of our businesses, specifically when you're in manufacturing, is the exchange rate. And I've put quite a detailed graph on the screen, and you'll see we're back to sort of the February 2020 exchange rate. So the 19 Rand to the dollar. We've seen some strengthening. We've seen some weakening again. The weakening doesn't necessarily correlate to any true economic drivers. But there's the positive and there's the negative when you look at the exchange rate. If you're an exporter of goods, if you're an exporter of commodities, the weaker the Rand, the better for you, because you'll start exporting more and more, and your conversion is really strong. Where if you're an importer, the weaker the Rand, the more your input costs are, and the more strain your cash flow is going to take. So again, industry specific, where is this Rand dollar exchange rate? And again, how does your company or your buyer manage that process? What put calls are they buying? What puts are they buying? What calls are they getting in place? What are the FETs? So a lot of that management comes into the exchange rate process for us. Not such a good outlook. Okay. Not such a positive outlook is that having been grey listed, I don't know if it's earlier this year or end of last year, having some news articles about potential sanctions listings coming through, the foreign holdings or the foreign investments coming into South Africa is reducing to some extent. There is, however, positive talk. So there's a couple of companies that have said that they're doing relatively large investments. I think BMW is the one that they've said they're building a plant of in excess of 5 billion Rand in South Africa. So this continuous sort of in and out and inconsistency, unfortunately, due to some of the political decisions we've made in this country, is not always positive for foreign investments. But we are still seeing foreign investments come into the country. But that obviously goes straight into our business confidence. This is the 5th quarter in a row where our business confidence has continued to track downwards. It is really driven by our geopolitical outlook, which is a little bit more global than it is local, and our ever-present load shedding is probably the #1 cause that we have heard through entities in why they have this negative outlook. Manufacturing is the lowest at a 17 points. So ideally, you want to be in excess of 50 points on this rating scale from the Bureau of Economic Research to be in a positive economic outlook. So where your manufacturing is down at 17%, there really isn't much good to say out there. A strange one, retail is only at 20 points on this rating scale. And I think that is potentially the outlook of just the average consumer on the road is struggling, and that free income or that money that is available for spending in things like retail, in the white goods and the yellow goods, that's where they are struggling at the moment. So as we can free up cash, as fuel gets cheaper, which again is linked back to the exchange rate, that obviously gives you a better trend. But what it's also saying, and if I put on our positive outlook now, is that we've got to start producing local. The more you import, the more expensive it is, the less people can buy, and the lower the profits are. So local manufacturing and local production is becoming more and more critical in this really strained local and global economy. So now that I've got all bad news behind us, you're welcome to crack a beer, take a shot of tequila, whatever works for you. But there really is some good news in the market. Our South African inflation rate, which I know we all gripe about, is down at 5.4%. It's sort of come down from 6.3% last month. But if you look at the graph and you look at the blue line, which is our South African inflation rate, it is still tracking relatively consistently in that 3 to 6% band. Yes, we had those couple of months where we went well over it, but we all know why that was there. But I've compared it to what we're seeing in the UK. And the UK inflation completely fell out of bed. And this was the same that we saw in Europe, and we saw the same in the US, where the inflation went from 0 and even negative 2% to close to 12% at one point. And the impact that they have seen on their businesses and in their economy has been far worse and far more sudden than we've ever had in the South African economy. So if I take your mind back to the 2008-2009 credit crunch, South Africa struggled and we all felt the impact. But our businesses were not as hard hit as the European and UK businesses. And we recovered at probably 3 times the rate those businesses did. And we're seeing something very similar if we look at these inflation slides and at the messages that are coming through the international markets. The corrections they've had to make in their businesses have been far more severe than we've had to make in South Africa. And similarly, it links straight into this slide. The business failure numbers, again, the blue line is our South African business failures. And for the month of May, there were 128 business failures or liquidations. Where you compare that to the access on the right-hand side, and which is the UK numbers, at the month of May, they were close to 6,500 business failures that occurred in that month alone. So yes, things are bad, but I think as South Africans and Africans, we tend to also always see the negative and see the worst part. I think our businesses have learned to be resilient, have learned to manage their cash flow, and those that have struggled have probably failed. But I think we continue, and the businesses that I've left have continued to grow in strength from where they were sort of through COVID. And I think going into trade credit, private sector lending, which is really the space we play in as a trade credit insurer, that lending has continued to increase. And for the month of, I think this is the month of May again, the debt availability has grown by 6.25% year on year, which means businesses are giving other businesses greater credit terms or larger credit limits. Banks aren't all likely providing bigger credit facilities for entities to trade in. The overdrafts are potentially not easier to get, but are more available.
And again, this is something where, as a trade credit insurer, we can add real value, because if you're concerned about your buyers, if you're concerned about those increased credit limits that you're going to give, that's where we can step in, assist with your underwriting, assist with the analysis of the balance sheet and the business behind the credit limit, and actually protect you in the event that that guy may have overtraded to some extent. So a positive outlook from a South African environment perspective is that the lending has improved, and I don't think we ever want to see it sort of above 8 to 10%, but at that mean of sort of 5.75%, it shows that corporate South Africa is actually trending upwards and doing quite well in terms of their cash management. Yeah, and that really is sort of a bit of the two halves of the South African economy, but happy to have a chat, answer any questions you may have.
Thanks, Celia. How do I start? Can everybody see me? Can you hear me?
Gareth, you're on mute there.
I'm off. What's important for us, I see Arnold's asked us about manufacturing. For trade credit, we often get a question saying, which sectors do we like, right? Which types of risks do we want to insure? And in reality, we don't have a decline sector. We've got, we believe that there are good risks everywhere, and what we don't like doing is chasing magic beans. If somebody thinks that everybody wants thingamajigs, that's obviously certainly not something that we want to sell. Or insure. But if somebody's got a robust plan and they've got real off-takers and they've got real people buying the businesses, that's the stuff that we really want to look at. But where the rand dollar exchange rate becomes quite important for us from a manufacturing perspective is that if we're importing finished goods, we're paying on a weak rand on a finished good price. So the rand exchange rate hurts us badly. If we convert it the other way around, and we import the input costs, right, on the weak rand. Still sure there's a little bit of pain, but at least it's on a smaller base, and we can manufacture it in South Africa. Then we're exporting a finished product on a weak rand, which means that actually there's a huge benefit to South Africa. And we've actually seen quite a few of our companies that export to the likes of America and mainland Europe, that when the rand tanks, actually their business does really, really well. So it's quite a funny one, right? There's a catch-22 there, but manufacturing is one of those industries that we're quite keen on finding the right way to do it. We find that there isn't a really good solution from a trade credit insurance perspective. There's the generic approach, but manufacturing is not that. And if we can get the manufacturing component right, then we can start really uptaking on employment and start fixing this country. So manufacturing is a really key industry for me, and I really relish the opportunity to see how we can assist your clients, especially in that manufacturing space, to see how we can assist them and find and call it the right balance sheet so that we can actually get cracking there. Graham, I see your hands up. This is new to me, so I'm going to try allow you to talk. There we go, Graham. I've now muted you. Graham, do you have a question there?
Gareth, there's another question in the Q&A. So if Graham does want to chat, maybe you can just shout out. But there's another question in the Q&A, Gareth. It says, could you just elaborate a bit more and explain the pay sooner part of our business, and maybe just recap the claims process and why we can pay sooner than our competitors?
Absolutely. Okay, great. Thanks, Just. So effectively, if you remember, guys, the policy holder, right, your client is the one that's selling the goods, okay, or rendering the service to another debtor, right? So on a credit transaction, so you'd be delivering today, let's say the 22nd of August, and the payment will only be coming on the 30th of September, right? That would be a 30 days from statement, which is the most common credit term that we see in our business. So the insurance is that you can take out that your client's not going to pay you on the 30th of September, right? But the policy only actually kicks in 60 days past due date. Okay, so 30 September, 31 October, 30 November is when you'll get paid under our policy. So that's the day that you'll get paid, is the 30th of November. The reason why we allow those 2 months, funny enough, is because we find that clients want to interact with their client. Policyholders want to act with their client before we do, because we're incentivized to collect debt, whereas obviously they're more worried about the relationship in the beginning. So we allow that time and we pay as quickly as we can. But from that point, you could wait up to 180 days later, between 120 and 180 days later. So you're kind of sitting there going 31 December, 31 Jan, 28 Feb, 31 March is when you'd get paid under a protracted default trigger for something that you delivered in August. Right? So we just found that that's too long to wait. And that's why we pay as quickly as we can, and that's why we'd pay in December. That's what we mean by paying sooner. As long as the debt is confirmed and the debtor agrees that they owe the money, that's when we would pay, because then we're carrying that cash flow risk. We did include, like I said, that protracted default trigger, and that's just to make sure that we're on line with the rest of the market, even though we do envisage that we're not really going to use that trigger too much.
Thank you very much, Gareth. And I'm going to test something else, and I'm going to maybe put you on the spot a little bit. So let's do a little bit of role play here, because I think one of the things about trade credit insurance is it's mostly sold by a very small handful of specialist trade credit brokers. And we love those brokers and we deal with them. But my guess is that most of the brokers on this call are not trade credit brokers. They are brokers that are experts in property and liability and motor and buildings. And I think they get a bit scared off sometimes when they have to raise trade credit with a client. So let's pretend that I'm a client and I'm a manufacturer of these pens, which you can't see because of my background. There you go, you can see these pens. And I'm a small business owner, and I've got a little manufacturing business, and I'm manufacturing pens, and you're a broker and you're coming to see me. Can you give me an idea of just how you would approach the conversation to say, why I might need trade credit and some of the actual benefits of having trade credit for my business? Let's have a little go and see how it goes. And to the brokers listening, maybe you could try this with one of your clients next time you go and see them.
So just, I mean, I think that's it's certainly putting me on the spot quite a bit, but certainly I think what's important there is that I really enjoy going with the broker to their client. And the reason why I like that is we find that the nuances of a company, every company is different. And if we think that one trade credit insurance product is going to meet all of their requirements, we're missing a trick and a really big trick. So what's important for me is that we take good credit risk, and then we structure the policy that we do. So what I always start off with is I ask the client to tell me about their business. I ask them to tell me what their credit terms are, what their preferred credit terms are. And that's a really important point, right? Because your credit term that you give is because that's the credit term that your client is prepared to pay you. Right? So imagine if your client is a retail client and they sell to Pick n Pay. Pick n Pay is at 90 days from statement. Not because you want to carry that cash flow risk, because Pick n Pay says that's when you're getting paid. So a credit term is often determined by the buyer as opposed to the policy holder, right? So that's quite important. So the mismatch there is you need to understand the client saying, when do you actually need the cash by? It's what we call as a DSO, so day sales outstanding. What is the best cash environment for your business? And we build the product from there. So we engage with the client and we say, firstly, tell us about your credit management process. Do you have a credit agreement? Do you have something in place? If you don't have one in place, we'll draft a credit agreement for you. Right? We don't charge a cost for that. We probably should, but we don't, because we believe that at least if a policy holder is using our credit agreements, then at least they're trading safely and they've got some recourse. They've got a document that's going to stand up in court. And that's what we find is the toughest environment. In the past, when the economy is booming, nobody needs to sell on credit because everybody's got cash, right? Then as the economy gets harder, everyone wants to buy on credit, and you have to then start accepting that without the economy being strong. So you end up selling on credit, but actually your business isn't geared for that. So we assist the client enabling it. So it's the holistic credit management. That how component is crucial for our business. The next component that I mentioned was that the who's. Right, so who exactly you're dealing with? Because if you don't know who you're dealing with, you could end up in a lot of trouble, right? We've seen a lot of instances where you've dealt with a client that you think is a really good client. right? And the benefit of dealing with a trade credit insurer is that we've got a broad span of industry knowledge and payment profile information. So every single one of our clients sends us their debtors aging on a monthly basis that we upload into our credit management system, and we can see every exposure across the country. We're processing, I think we're now at about 270,000 lines of data information that we process every month, right? So we get to see, your client might be paying you now, but they're not paying somebody else in the background, and at least we'll pick that up so we can advise the client. So that's a really important component, is that the client gets kind of a big brother support when selling on credit. And probably the last thing that I'd add to that is, what's important is that clients often think that if we decline a risk, that we're robbing them of their sales. The trade credit insurance company doesn't want to give us cover, now I can't sell. This product isn't working for me. And as I mentioned before, we only charge risk premium. So we're incentivized to going on risk. So when we're saying no, and we're telling you the reasons why we're not going on risk, that's a really important kind of flag to listen to, right? This is not us walking away from a risk because we don't want to pay claims. This is us saying, guys, this client's not going to pay you. And if the client has a default, right, worst case scenario, they've got an excess on their policy, right? Which means that you're just in business to push product. And nobody's in business to push product. People are in business to make a profit. And trade credit insurance kind of enables that ability to lock in your profits and gain comfort in how you sell on credit. And if I may, just one little quick anecdote, which I think is really useful, is we've got a client, we'll try to keep this as generic as possible. They're somewhere in the country, and what was quite interesting is that I met with them after they incepted the policy, which is a really important component for me too. I love meeting clients generally after the policy is incepted as well, if I haven't met them in the sales stage. And the reason why I like that is because the policyholder is only interested in cover and the price, right? Up until the policy incepted. They're not really listening to the terms and conditions and the nuts and bolts. They just want to know if they've got cover. So when you sit down with the client after that, not at claim stage, just after the policy is incepted, you say, tell me about the product. Tell me about what you think you bought. You have some really interesting engagements. And we had this client, which is a great textbook example, where they were with another trade credit insurer, and I said, tell me why you left. And they said, well, they left because they had a frustration that they would, get an order, and it took them 90 days to manufacture the goods. Okay, so they get an order on, let's say, on the 1st of July, and they know that they're only going to deliver on the 1st of July, August, September, on the 1st of October. So they see they've got cover, they accept the order, they start producing the goods. And then during that cover period, the insurance company withdrew the cover, and now they're sitting with a whole bunch of manufactured goods that are tailored for that client. And now they've got a choice. They can either burn them or they can sell them to somebody who the insurance company has just told them is not going to pay you. And I said to the client, the funny part is that you actually don't have cover for us either. And I said, but what we will do now that we know what the problem is, I said, we'll endorse your policy to make sure that you're covered for that manufacturing lead time, right? So that you've got what we call as a pre-delivery cover. And then I said, we're going to go one step further, that if you get something or an opportunity that's got a manufacturing lead time that's up to 3 months, phone my underwriters, phone them, say, can you guarantee cover for the next 3 months on this buyer? Our underwriters will do an assessment and they'll say, yes, we'll guarantee you cover, that you will have cover on the day that you're going to deliver these goods. So now the client's got peace of mind again. And that type of conversation doesn't happen if you're not sitting in front of the client asking, I suppose, the right questions and really letting the client tell you about their business. As I said, we tailor the solution around the client, but based on really solid underwriting. So we don't ever fiddle around with how we assess risks, but we really tailor our policy to respond the way the client needs it to respond in their business, not in somebody else's business.
Perfect. Thanks very much.
So Justin, maybe another point to discuss is, again, when you're having the discussion with your policyholder, what is their cash flow process? A lot of these larger corporates are having discussions with banks about overdraft facilities. They're having discussions with banks and other financial institutions about data factoring. So when you're selling your debtor's book, the bank or the financing house will give you 45, 50, maybe 55% of your debtors book in cash up front, which is another cash flow management opportunity that clients utilize. If you can put a trade credit policy behind that, some of those banks will increase that factoring probably close to, I think at the moment, 70, 75%. You know, if you're taking 10% in your cash flow today, that can be quite a material change in how you operate your own entity. So I think, like Gareth said, everything is how does your client operate? What is their cash flow management? What is their data management? And you build it around that.
Okay, great. So we've got a couple of things, and maybe just to summarize some of it for the people like me that aren't experts in this. I think if you're a broker, there are a couple of things that are really important to talk to your clients about. I think the first question is, who are you dealing with? Who you are selling credit to? Do they have credit agreements in place? What are the credit terms and how they're managing their cash flow? And then the last thing that I would say to them is, how can we help? And I think, as you've heard from Gareth, we're more than happy, or Helene, we're more than happy to come and visit a client with you and explain the process and the product with them. So I would encourage all of the brokers on this call, ask your client, one of your clients, some of these questions, and give Gareth or Helene a call, and we'd be very happy to come and sit with you and your client, or have a call with your client to help explain how we work it. We've got a couple more questions that have come up. So Gareth, clearly you've been talking something interesting because a few more questions have come up. We've got a question from Michelle, and Michelle's had a couple of good comments as well. So thank you very much, Michelle. Michelle really liked the line that trade credit promotes profit and it doesn't push product. And Gareth has always explained to me, trade credit actually enables small businesses, or any business for that matter, to sell more product because they can sell on credit. So I see trade credit as a great way, particularly in a tough economy, to help small businesses sell more because they're selling on credit. So thanks for your comments there, Michelle. Michelle has also asked a question about will we place business or write business from a non-specialist trade credit brokers? And Michelle, I think we've answered that question. We do love working with the specialist brokers, but we're also happy to write trade credit from any of the other brokers on this call, or any of the brokers that we deal with. So I think that answers your question. And then Gareth, we've got a question from Raquel Gomez, and she says, how in-depth is your vetting process before the cover is granted? And I think an important question, does the third party know that they are being vetted, and for what reason? Maybe you want to comment on that. I think that's quite a nice question.
Absolutely. So it's one of those, how long is a piece of string? I think that's one of the conversations that we have a lot with clients is, what are your turnaround times in order to grant cover? And in reality, we can do it quite quickly. We can do same day if you really want to. But the real answer is it probably takes us 4 to 5 working days to do a full assessment on a meaningful risk. And the reason why it takes us that long is because we've got a number of stages in our underwriting process. We pull bureau information, we analyze the financials. If we need to, we do a buyer visit so that we can get a full view. But probably the most important part of that process that takes the most time is the legal verification of that credit agreement and the fraud verification of that credit agreement. That's the part where often you sit with a client and they say, oh, but can you do it in 2 days? Because your opposition can do it in 2 days. And I say, guys, we can do it in 2 days, but you've got to understand then that I haven't looked at your credit agreement and you don't know if you're in the donations game. Because if that document is rubbish, you're back in the donations game, right? And fraud is something that's not covered under a typical trade credit insurance policy, but we've gone one step further and through, because of our fraud verification component, we end up picking a portion of fraud. So last year, I think I did a fraud talk, and I went through quite a bit about fraud, but just for an update, fraud splits into 2. There's what we call as impersonation, right? So that's where somebody's pretending to be a company. So your client is not who they think they are. That's the one that's typically it's not covered under our policy either, because we're ensuring that the business that we underwrote, not the business pretending to be the one that we underwrote. But the other component of fraud is where there's a scam, where it's what we call a real fake businesses. It's a real registration number, real directors, real financials, real trade references, but they're all fake. That's covered under our policy because we take that fake business to court and we'll get a judgment against them because the crooks run away. So we end up paying that claim. So we're the only guys that end up paying under some of the auspices of fraud because we confirm the debt against it. That's kind of a slap on the wrist for us in our underwriting assessment. But in reality, you know, the crooks are always going to be smarter than the legitimate people. So there'll always be gaps there. So that's how long it typically takes, about 5 days to underwrite a buyer. When we are taking on a policy, it'll depend on the number of debtors the client has selected for cover. Some of our clients have got thousands of clients or debtors that they want to insure with us, and that take-on process can take some time. But we engage with the client, we make sure to understand how long the take-on process is and what the hoops are to jump through. The second part of your question was about confidentiality. It's quite a tricky one. In the beginning, we used to offer, call it a confidential underwrite, where the debtor wouldn't know who the seller was, right? So it was call it a blind underwrite. And then we used to contact the buyer on behalf of Hollard Trade Credit. And we just found that the quality of information that you'd get back wasn't meaningful because they want to know who this person is that's underwriting them. And the credit agreement says that you can, right? The policyholder can request this support. So we found that the quality of information that we get is far better when it's disclosed as opposed to a non-disclosed underwrite. And, you know, because of the state of the economy, very infrequently do we find a debtor that says, "Oh no, I'm not giving you anything. I'm not going to chat to you." That's that's just rubbish. So we find that people are open, and trade credit insurance is starting to come a little bit more, kind of penetration. The market is on the up. We find that 60% of our new policies are new to trade credit insurance. They've never had credit insurance before, so we're really good at holding their hands and kind of taking them through that process. But those days of kind of having to do it on a confidential basis, I think, are gone. And if I can, just one little add-on, we released a document, what we call it the 5 key touch points, especially for the non-trade credit brokers out there. And the 5 key touch points is what is trade credit insurance, right? A little bit about the product. The second one is how to assess a quote and the questions to ask your client to understand which type of policy they're looking for, because they've got different processes. The third one is how do you read a quote? So when you get a quote from us of our system, you'll be able to compare it with that request to quote, with that 5 key touchpoint document, saying this line item means that, with an explanation and an example of each line item, so that you can advise your clients exactly what it means and how much it's going to cost them and what type of cover they've got. The fourth component is incepting a policy, so the process that we have to go through in order to onboard a policy as swiftly as possible. And then the fifth part is monthly management of claims. So it's the questions that your client would ask us at claim stage, right? When can I do what? How can I do it? What happens if this happens? How to have a free and fair claims experience? Because that's really what we want, is we want our clients to be comfortable with us, that when there's a claim, it's not this big surprise and it's not a hack. So we underwrite at underwriting stage to make sure that we are on risk and the client's got peace of mind, so that when it comes to claims, it's effectively as easy as, did your client order this? Did you deliver what they ordered? Did they receive what they ordered? And have they paid? And if it goes yes, 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 no, well, then we must pay, right? That's kind of how simple the product is supposed to be. So it's just unfamiliar. It's not really difficult.
Gareth, the last question, do you pay banking details theft fraud? So someone hijacks an invoice and resends it with new banking details.
That's an interesting one. So we would pay we obviously pay out a non-payment, right? I think that's the point. So if we would go back to the debtor saying, have you paid or haven't you paid? I mean, in essence, the debtor hasn't paid. So I suppose we'd have to follow that. We haven't had one of those eventualities yet. I know we were discussing with the commercial crime team at a stage to see if we could do a banking details kind of endorsement on the policy. There was something that we were working on at the time. It's a good question. I'd have to come back to you on that, if you don't mind. It would depend on what the credit agreement says. Some credit agreements say if it's not in our account, it's not paid. If that's the basis that we'd be insuring you on, then we would still pay a claim on that basis. If the credit agreement is silent on that, then I'd argue that the debtor may have an argument in court that says that they've paid, you just haven't received it. So it's a bit of a touchy subject, and it would depend on the credit agreement. Much like, funny enough, force majeure, right? People ask us a lot about force majeure during COVID. Is there no cover? Does it respond? How does it work? And in reality, it depends what the credit agreement says. If your credit agreement is silent on force majeure, well, now you're in a bit of trouble. But if it's not silent and it tells you how the product needs to behave, then we'll behave accordingly, because that is the agreement that we're ensuring. And that's why that credit agreement is so important for us. And for the life of me, I can't understand why it's not a requirement elsewhere.
Gareth, just two things from me. I mean, just to comment a bit on that, we see that in cyber insurance as well. So another good reason to tell your clients to take out cyber insurance, because that would cover many of these sort of losses if there is a breach of your system. And often it would depend where the fault would lie. Of course, it depends on the credit agreement. But if there was a hack on the person who's paying side of things, then it usually in case law it's deemed to be their fault. So then they would have to then repay. If there was a hack from the receiver of the money, it was their fault, then I think you could get into a legal dispute. So I think legally you'd have to look at where was the fault and where was the breach that it caused the hack that resulted in non-payment. So just an interesting side. We see that a lot on the cyber side of things. And then also, Gareth, I'm probably going to flood your inbox a bit. I thought I'd put a little challenge out to some of the brokers. And just to be clear, we don't want to get involved in conflict of interest and giving you gin to get business. But I thought it would be a fun little challenge to say to any of the brokers out there, if you've liked this conversation, and if you'd like Gareth to have a meeting with one of your clients to explain trade credits, please send them an email. Use the heading iTOOGin, and the first 3 brokers that contact Gareth and actually set up a meeting will give you a bottle of our special own iTOOGin. We've got an iTOO branded gin. It's called the Underwriter. It's a London dry gin, and it's really delicious. So a little bit of encouragement for you to show you that we're serious about holding your hand and helping you if you have clients. Email Gareth, tell him it's for iTOOGin, set up a meeting, and we'll make sure that you get a bottle of iTOOGin. And thank you very much. I think that brings us to the end of the session. I'd like to say to Gareth and Helene, thank you very much. It's been a really interesting conversation and sessions, and thank you to all of you for listening and the questions. And if there's nothing else, then I think we'll start to wrap up. Gareth and Helene, anything else from you guys before we wrap up?